Hello and welcome. If you're running a limited company here in the UK, you know that corporation tax is just one of those things you can't get away from. But are you sure you're getting it right? Well, in this guide, we are going to break down absolutely everything you need to know for the 2025-26 tax year, making sure you're compliant and, not paying more than you have to. Let's get right into it.
So, let me ask you, are you losing sleep over your CT 600 form? Do you have that little nagging feeling in the back of your mind that maybe, just maybe, you're overpaying HMRC? Or even worse, underpaying? Look, you are definitely not alone. For so many business owners, corporation tax is a massive source of stress, but it really doesn't have to be.
That's exactly why we've teamed up with the amazing experts at ProTax Accountant to bring you this discussion. They specialize in UK tax, helping businesses just like yours stay compliant and financially smart. So you're in very, very good hands today.
All right, here's what we're going to cover. We'll kick things off with the absolute basics. Then we'll walk through the core calculation itself. We're going to look at the current tax rates, explore some really smart ways to legally shrink your tax bill, and finish up with those critical deadlines you just can't afford to miss. And of course, we'll wrap it all up with the key takeaways.
Okay, so first things first. What exactly is this thing we call corporation tax? Let's strip it right back to basics.
To put it simply, corporation tax is the tax your UK limited company has to pay on its profits. Now, this isn't just the profit from your day-to-day sales. It also includes income you might get from investments or even cash you make from selling assets, like a piece of equipment or a property. The really crucial thing to get your head around is that it's a self-assessed tax. That means HMRC expects you to do the maths, report the correct figure, and pay up on time.
Right. Now this is where things can get a little tricky, and it's where a lot of people get tripped up. You don't just look at the profit figure in your annual accounts and slap a tax rate on it. Oh no. First, you have to adjust that number to find your taxable profit. That's the specific figure that HMRC actually cares about.
So, the process pretty much looks like this. You start with your pre-tax profit, the number from your P&L account. Then, you have to add back any expenses that HMRC says, nope, you can't claim for that. Things like entertaining clients. Next, and this is a big one, you take out the depreciation figure and you swap it for something called capital allowances. After you've applied any other tax reliefs you might qualify for, you finally land on your taxable profit. And that is the magic number.
Let's just pause on this for a second because this is so important. Depreciation is purely an accounting thing. It's how you spread the cost of an asset over its life. But capital allowances, that's HMRC's own set of rules for giving you tax relief on those big purchases. They are two totally different things for two totally different reasons, and you just can't mix them up.
So, once you've got your taxable profit, the next step is figuring out which tax rate to use. You see, the days of a single flat rate for all companies are long gone. Since April 2023, the UK has used a tiered system, which is actually designed to be a bit fairer for smaller, growing businesses.
This chart shows the structure for the 2025/26 tax year perfectly. If your company's taxable profits are £50,000 or less, you pay the small profits rate, which is 19%. Simple. If your profits are way up over £250,000, you pay the main rate of 25% on everything. But what about that big gap in the middle? Well, if your profits are between those two figures, you fall into this band called marginal relief, where your effective tax rate sort of slides up from 19% towards 25%.
Hey, here's a quick pro tip. You might hear tax people talk about augmented profits. Don't let the jargon scare you. For most small businesses, it's going to be the exact same number as your taxable profit. It's just the official term HMRC uses to decide which tax band you fall into. It really only changes if your company gets dividends from other companies it's not connected to.
Okay, theory is great and all, but let's make this real. Let's meet Chloe. She runs a successful design agency in London. And this year, her limited company has made a taxable profit of £150,000. So, as you can see, that puts her right in the middle of that marginal relief band. So, how on earth do we work out her bill?
All right, I know this looks like scary maths, but I promise it's not as bad as it looks. First, you just calculate the tax on her whole profit at the top rate of 25%. That gives us £37,500. Next, we figure out the relief she gets. You take the upper limit of £250,000, subtract her actual profit, and then multiply it by this little fraction HMRC gives us, which is 3 over 200. That gives her a relief of £1,500. The final step, you just take that relief away from the main tax figure. And there you have it. Her final tax bill is £36,000. See? Not so bad?
Okay, so that's how you figure out what you owe. But what if you could legally make that number smaller? Now we're talking. This is where you shift your thinking from just paying tax to actually planning for it. Let's look at some really smart strategies, because this is where good planning throughout the year can literally save you thousands.
Here are some of the most powerful tools in your arsenal. You should always be maximizing your capital allowances, especially with the annual investment allowance sitting at a very generous £1 million right now. If your company is doing anything innovative, R&D tax relief is an absolute must-claim. Got patents? The Patent Box scheme can slash your tax rate down to just 10%. And hey, don't forget the basics. Making pension contributions from the company and claiming every single legitimate business expense are fantastic ways to chip away at that taxable profit.
I really want to zoom in on the power of R&D relief for a second. Stay with me here. This next point might surprise you. For small and medium-sized businesses, this scheme is an incredible game changer. It basically lets you deduct an extra chunk of your R&D spending from your profits. I mean, think about it. For every £100 you spend on genuine innovation, you can knock a massive £230 off your taxable profit. It's a huge incentive from the government to get businesses creating cool new stuff.
Right. This next part is absolutely critical. Getting the numbers right is one thing, but if you don't file and pay on time, HMRC will hit you with automatic penalties, no questions asked. So let's talk about the key dates you need to circle in your calendar right now.
There are 2 dates you need to burn into your brain, and they are not the same. Your deadline to pay your tax bill is 9 months and 1 day after your company's accounting year ends. But your deadline to actually file the tax return, the CT 600 form, is a full 12 months after your year end. That's not all. Here's where most people go wrong. Yes, you read that right. You have to pay your estimated tax before you've even filed the final paperwork. It's a classic trap.
And if you miss that filing deadline, well, the penalties start instantly and they get painful fast. You're hit with an automatic £100 fine the very next day, even if you don't owe any tax. After 3 months, it's another £100. At 6 months, they add a penalty of 10% of the tax you owe, and they do it again if you're a whole year late. These are just unnecessary costs, so getting your dates locked down is essential.
Okay, wow. We have covered a ton of ground. I know. So let's just take a breath, pull it all together, and run through the most important facts and figures that you need to take away from our discussion today.
If you remember nothing else, remember these key figures. The small profits rate is 19% for profits up to 50 grand. The main rate is 25% for profits over 250 grand with that marginal relief in between. Your payment is due 9 months and 1 day after your year end. You've got 12 months to file the actual return. And finally, you have to keep all your business records for at least 6 years.
So hopefully that fog around corporation tax is starting to lift a little bit. But look, this has been a general guide. Every single business is different, and applying all these rules to your specific situation, well, that's where the real magic happens. Getting some expert help is often the smartest next move you can make.
If you want to be absolutely sure you're compliant, you're maximizing every possible relief, and you're planning for the future effectively, I would strongly recommend reaching out to the team who made this guide possible. You can contact ProTax Accountant directly on WhatsApp or give them a call on 07985 689 912. Or if you prefer, just drop them an email at info@protaxaccountant.co.uk for advice that's built around your business.
Thanks so much for joining me. If you found this helpful, make sure you subscribe to the ProTax Accountant YouTube channel for more clear, practical guides just like this one. Until next time, ask yourself this: are you just paying your tax or are you actively planning it?